Good morning, everyone. My name is Dave Greene with NIW. Glad you're on today. It's a beautiful Friday afternoon. I hope you have a great holiday weekend when we're finished. Today I'm going to talk a little about the Kai-Zen plan as it in its simplest form, and then a little bit about compensation, because a lot of people are a little apprehensive about number one, spread comp and how it's paid, and number two, about whether or not you like the idea that you split on the app with NIW. And so I'll just try to dispel that issue and show you how you'll make a lot more money by selling Kai-Zen, even with the split on a spread comp, than you would otherwise if you did it yourself. Now, this is only a training presentation. I will be recording it, so it's not necessarily for clients, primarily because they don't want to know about our compensation. So with that said, let me get into the basics of Kai-Zen and kind of how it got started. First of all, I would always ask, why would you want to sell Kai-Zen? Most clients don't even know what IUL is, let alone what Kai-Zen is. Well, number one, it's a better way to solve your client's needs, and that's your objective. Number two, we try to eliminate the competition as much as possible. And that's like you'll usually hear me say a lot of times, if you send an illustration or a brochure or anything to a potential client without being face-to-face to explain it, it's possible that the next person that sees that is your competition. Now, quite frankly, your competition may not even know what it is, and if they see the word financing, they're going to say, hey, you're not going to walk away from that. You're going to run away from that. And so a lot of times we'll send out information to the client, and then we can't get a hold of them. They go silent. And that's probably why they take it to somebody else that isn't competent enough to understand how it works. Number three, we want to make more money than the traditional sale. Now, we want to make sure that our clients get the best deal possible. However, we also want to make as much as we can as well. Now, let's keep it simple. Whether you sell for income or benefits, this concept merely involves a standard IUL. It's no different than what you're selling today. The only difference is we just have the ability to pay 75% of the entire 10-pay premium using other people's money. And so with that said, it does become a premium finance strategy, but it's not the traditional one, and you'll see that pretty soon. Kai-Zen does not change the structure of the IUL contract. And so a lot of times people will ask me, well, how do I work Kai-Zen in a deferred comp? Well, it'd be the same as if you worked traditional IUL and deferred comp. So you have the same tax treatment in any concept that you're working with, same flexibility as long as the loan is paid off. And I'll kind of go into that too. That's one of the pushbacks, is what happens if I can't make the first 5 payments. So we'll get into that. Or what happens if I need to utilize my accelerated benefit rider. Okay, well, it's completely liquid as long as you pay the outside loan off. First things first, always sell the need, and the need isn't always for commission, because that'll come. If you can satisfy a need for a client, the commission will come, and it'll be nice. And we'll find out that selling the case is of the utmost importance. Okay, let's define the market. First of all, we can use Kai-Zen in the personal coverage arena, and that's where there's a few rules. One is ages 25 to 65, and standard or preferred risk non-smoker. Also, we have an annual income of no less than $100,000 a year. That's a little different than in the traditional financing arena, where you have to have a net worth of $5 or $10 million. Here, we technically need no net worth other than the fact we need an annual income. Now, why do we have the other rules? Well, when we stress test these contracts, and I'll kind of get into the stress testing, that at age 66 and above, the mortality when you start a plan is much greater than at under 65. And so when we stress it, it may work, a 65 to 70-year-old may work in today's marketplace at 7%, but if we stress test it, it falls apart because of the high mortality. Same thing with standard or preferred risk. If I have a table 6 on a 62-year-old, probably won't pass the stress test. So, however, if I have a smoker that's under 40, or maybe in fact, we had a type 2 diabetic that was 35 years old, table 5, and it actually passed the stress test, primarily because of age. And so it's the age that crushes you all the time. Minimum face, 1.5 million. Maximum face, 4 million if the net worth is under $5 million. So I may have a client that has a $200,000 net worth and is making $300,000 a year. Well, that would qualify for up to 4 million of face. The reason why we have the 5 million is because whenever you get into premium financing and you take it to a reinsurance company, they require that the net worth be 5 million if we're financing, period. Now, if we can keep this in-house in the carrier, we don't go to reinsurance, our carriers have gone up to 4 million without that requirement. Now, we created this contract primarily for the business market to recruit and retain top talent, because that's where the action is in today's marketplace, is the business arena. So whether I use it for, let's say, a 162 bonus, maybe a key person contract to cover deferred comp or salary continuation, or maybe a stock redemption plan, or just a plain vanilla buy-sell arrangement, we can use that in the business arena as well. So what you're seeing here is pretty much any way that you use a traditional IUL, we can use Kai-Zen and supersize it with other people's money, with 75% more of other people's money. Now, we all know that index products were created for growth and income, not necessarily a death benefit play, and that's why it was created. So if I took a male 50 standard 1.5 million, there are a few questions that I'd ask my client. Number one is, do they think it's better to overfund or underfund one of these contracts if we're after growth and income? Well, ideally, it's best to overfund them, because we want to get as much money in these things as possible so they start compounding. Number two, would it create more or less cash value if we condense 15 years of premium into 5 years? Well, another easy answer. Yeah, it does. It creates more. How about, would it help if we added 3 times the premium using somebody else's money? Now, your client will always nod yes. Of course it would help. When they nod yes, they've just pretty much agreed to financing. Now, once you show them how we mitigate risk in the financing side, they will be more inclined to go with the case. Now, there are 2 key elements to a sound financial plan. We know that our products are tax efficient. Now we're going to throw in accelerated growth, because a lot of times our clients have X amount of dollars to deal with when investing, and it's not quite enough to get them where they need to be at 65. So they need the added accelerated growth from other leverage sources. They know that the wealthy get more wealthy because they finance most of their growth patterns. So there's a concept that I want all my clients to understand, and it's called filling up the tank. Why overfund? Well, this kind of shows why you would overfund. I'm going to take that same 50-year-old male non-smoker standard, 1.5 million, the minimum face, and a 7% crediting rate. You can use anything you want. It all works better than the IUL without financing. So if I took, let's suppose I'm not financing. If I took $40,000 a year for 15 years, because a lot of people will show a 15-year payment plan, that may be target, I don't know, and I know that nothing else changed, I would want to know, because this is a growth vehicle, I want to know what the net return is in the 15th year. So I'm 65 years old. If nothing else changed, I've got just shy of 700,000 in there. What do you think the net rate of return is? Well, it wasn't as exciting as I thought. 2.08%. Now, this is, your client is going to say, well, this isn't what I was looking for. And you could say to your client, well, 2.08 tax deferred with tax-free income, a $1.5 million permanent plan as well, That's not too bad in today's marketplace, but it wasn't what they were looking for. And the reason it looks like this, and a lot of people sell this type of contract, is because they didn't fill up the tank, because the IRS says, I'm allowed to put in $80,000 a year into this for 15 years. So if I did that, I would have 1.7 million of cash. Did that change my net rate of return? Well, of course. It went to 5.4%. Now it's starting to look a little more attractive. However, I put in a lot more money, but I'm getting 5.4 tax deferred with 1.5 million of coverage, and I can take it out tax-free. Not bad. It's starting to look a lot better. But take a look at this. In other words, the difference between the 40 and the 80, that extra 40 that went in, what did it earn as a rate of return on by itself? In other words, I would take the 1.7 million less the 696, and I would say, what would that extra 40 get with that increase? Guess what? 7.97%. It was more than the crediting rate. Why? Because the first 40 covered not only the mortality and expense, but an additional 2%. The additional 40 only added to the net rate of return, but by itself, it actually made just shy of 8%. Now, if we said, all right, if we had a lender that loaned us the $40,000, what would our additional 40 do? 8%. So in other words, now the client knows that they're getting 8% tax deferred, $1.7 million, a little less than that because of the financing, but we've got $1.5 million of coverage. So it's quite an investment strategy, I shouldn't say investment, on behalf of the client, just because we financed the additional amount. Now, there's one thing that a client has to know is how we leverage this. In other words, how do we use our banks to fund a portion of the premium? Well, number one, the Kai-Zen plan requires only 5 annual premiums. In this situation, I'm going to reduce the client's age to 45, male standard, and in that situation, based on 1.5 million of coverage, he would have, and this is a male, would have to put in $33,000 a year for only 5 years, and then they're done. Now the banks come in and they say, well, we'll put in an amount right up to guideline premium so that we'd never want to mech this contract. And you'll see that we've put in more than we need, up to the max for 4 years, then we can only finance $16,000 in the 5th year. So a couple things you're seeing are happening here. It's 1-to-1 pretty much match in the first 5 years. The second 5 years, the bank puts in the entire guideline premium, $65,000 a year for those 5 years. So here's what's happening. We're filling up the tank. We're going maximum guideline premium. Only 75% of the entire 10-pay premium was being funded by a third party, and we're finished after 5. You can see the growth potential. Another thing is that the banks won't require that we pay interest. Now here are the advantages. The plan is the sole and only security for the loan. So we don't have to post collateral. All we have to do is say we have a collateral assignment on the policy. Number 2 is participants need not qualify or even sign for any loan. So they don't, some people would say, this is the best non-recourse loan ever. Well, it's better than a non-recourse loan because they don't even sign for a loan. And so that's the advantage, and it's a cookie-cutter approach. They don't have to deal with the lending at all. And no interest payments are required until the loan is retired. Now let's take a look at why the bank likes this. Because we'll put in approximately $70,000 in the first year, of which 37 is the bank money. So because we use early cash value riders in this contract, we may have about $63,000 of surrender value in year 1. So if I have $63,000 of surrender value and the bank says, wow, we're only putting in 37, they know they're well collateralized. And that's why they don't require the need to qualify or sign for the loan. They know that the policy will act as its own collateral. And if we pay the second year, now we're compounding the additional collateral. So as long as we keep paying premiums, we're exceeding the loan and the interest rates and the mortalities all the way out. So let's continue on. Let's take a look at your money alone versus Kai-Zen. So I'm going to show the same IUL, 45-year-old standard male, 7% return. This, by the way, is the average of the last 25 years. The death benefit, 1.5, and we put in $33,000 a year, and let's show it without Kai-Zen. In other words, this is what the public is seeing all the time. However, they're probably not seeing a 5-pay, but we're going to have to compare the 5-pay to it. Of course, the longer you pay, the less the rate of return you're going to get, and I'll show that too down the road. So here's what happens, is that we would take the 165 and we would say, okay, at age 65, 20 years down the road, how much can we take out tax-free? And so from 65 to life expectancy, we're able to take out $42,000 a year, and that adds up to $840,000 of tax-free money. That's really good. In fact, that's why people are buying this. 165 to get 840, and I had $1.5 million of coverage. Nice case. However, let's show Kai-Zen. We have the same 5-pay premium, but our lenders will help us out with additional leverage, and we'll have an additional $489,000 added to the pot. Now at 65, usually we pay this off in 15 years. Now I can pay off this loan with outside money, or I can utilize the cash value in that policy to pay off that loan. In this illustration, I'm taking the money from the policy to pay off the loan in the 15th year, and then at 65, how much can I take out after I've paid off the loan? Well, I'm able to take out $77,000 a year for the same number of years for a total of $1.5 million, almost double what I could take out without the financing. And the loan's all paid off. So this thing really compounds itself. Now, if you're a good agent, you'd probably say to your client, wait a minute, this is compounding tax deferred. Let's take your taxable money first, like your IRAs, your 401ks. Let's take that first and let this sit for 5 years. So if I did that, I have the same product, but I'm going to take income from age 70 to 90. Well, now I can take $120,000 a year for the same number of years for $2.4 million. That's huge. And almost an additional $1 million just by waiting for 5 years. Kind of like Social Security. Maybe not. And the problem with Social Security, this would be my luck. I'd wait till 70 to start taking my money, and at 69, Gabriel would blow the trumpet. I'd be gone. And of course, it ruins everything. Here, if I died at 69, I'm not too worried about the $120,000 because I have this huge death benefit that will pay my heirs, much more than Social Security. So whether you die or not, your heirs are taking advantage of this. Okay, here's kind of what's going on. You have now the ability to leverage additional benefits with no financial underwriting for the lending, no personal lending requirements, no application, and no need for any outside collateral. It's all taken care of for you. Now the loan rates, because of how we do this, and I'll kind of show you how the trusts work, but the loan rates are LIBOR plus 175. This is the spread. This is the 1-year LIBOR rate. We have a floor of 275. Right now, I think we're a little over 3% on the loan rate. Now, the administrative fee is $1,500 a year for the 5 years that they'll be paying premiums, but that covers 15 years of coverage or until the loan is paid off. And so that's the only way we could get the entire 15 years of admin is to pay for it in 5 years. Now, every one of our illustrations will have this built in to the cost of the plan. So what they see will include the $1,500. Now, because it's a 5-pay, on 1.5 million, you see here that on a 45-year-old, the 5-pay was $34,500. You know, I illustrated $33,000 if you recall, and so what you see on the illustration would be adding the $1,500 fee. So I've got $34,500 a year for 5 years. Now, if the older I get, I have to pay more because my mortality starts climbing. So at 60, I've got $64,000 a year. 65, I'd had 83,000. Of course, the younger I am, the less the premium. And so at 30, a male might be $19,000 a year for 5 years, and they're taken off. Of course, the income at 65, of course, is a lot more because you have more time to compound. Now, somebody might say, well, why are you only showing cash values after age 55? Well, primarily because when we get past 65, there's still a lot of cash in there, but they may not be using it primarily for income as much as they are for the life insurance and the accelerated benefit riders. And so you'll find, here's an example. I had a 64-year-old with a $1 million Northwestern Mutual policy, and basically they said to me, well, wait a minute, you're showing me 1.5 million, so I'm picking up 33% more coverage, and I get the accelerated benefit riders. I don't have that. And if I take a loan from my existing policy to pay the 83.5 every year, I can pay that for 3.5 years, and before I even have to pay a premium. And then I only have 1.5 years left. So in other words, 1.5 years is a lot better than having to pay that policy that I have now for my lifetime. So they love those concepts. Now, down the road in 15 years when we pay off the note, there's still a ton of cash in there if they want to use it. All right, how is it structured? Well, it's a partially funded, partially financed transaction. The policy is the sole collateral for the transaction. And we create what's called a master trust, and we bundle multiple policies together to get the best loan pricing that we can get out there. So in other words, we may put together what's called a tranche, and a tranche is a group, and we may have, our last tranche was over 70 lives. And so if we take 70 lives, now we can go to the lender and say we have 8 million of loans that we need from you a year. Well, that's a lot better than coming in with 37,000. So we get the best loan rates, the best note rates, and we're able to do what we do for this reason. Now, we create individual sub-trusts for each client. And so those sub-trusts are never commingled. It's not a multiple employer trust or anything like that. And so, and I'll kind of show you how that looks. Well, I'll show you right now. Is if what we do, we open and fund each individual's trust. And so Dave might have the beneficiaries be the kids. Paul maybe have a partner in his business or a wife, or maybe an existing dynasty trust can be the beneficiary. But these are personal trusts. They're created for each individual based on what they want to do. It can be irrevocable or revocable. 99.9% of the time it's revocable because they want to utilize this for income down the road. Now, what we do, we create a master trust for each tranche, and basically the master trust becomes the borrower. So the master trust says, all right, I've got all this money going into these policies, so they go to the bank and they say, what's our best note rate we can get based on, let's say, 8 million a year, and the bank gives us the rates. Now, the borrower or the master trust fills out all the paperwork, and then what they do, they take on the note. You don't have to, and they just put the money into each contract based on what they want. And there's a collateral assignment. So it's very simple, and the banks really like this program. Now, there are 3 questions the clients may have and how we've tested for that. So their first question would be, what if loan rates go up? And we know that they're starting to climb, and they'll go up and down. I think the average loan rate is something like 4.5%. And so you will always get this question. Now, how you answer that is critical. First of all, we stress test these programs through the worst economic loan rate in history. And so that was through the 80s when Carter was a president. Well, actually, Carter helped to create the loan rates, and then Reagan came into office. So you can see here that here we've got it through the 80s, you saw loan rates as high as 16%, which is quite high, and we're in a fairly low loan rate environment. So the other thing we we looked at is that there was a historical spread between loan rates and crediting rates. So this is what the banks are looking for, because if all I have to do is outperform the loan rate by as much as, let's say, 1.25%. And so if I have a loan rate of 7, I need 8.25 of crediting rate to outperform the deal and make it work. So in other words, what we did, we went back every 15-year period since 1930, and we found that every 15-year period we had over a 2% spread between the crediting rate and the loan rate in every 15, more than 2%. That was the minimum. So historically, our actuaries have shown us that there's a 99.6% probability that if you stay in this for 15 years, you're going to outperform the loan rate by over 2%. That's a pretty good deal. Now, short-term rates, like bond rates, will increase the carrier's general account fund. And so we know that if loan rates go up, short-term rates will go up because they're correlated. They correlate between one another. And I can show that as well. And so as the short-term rates go up and the long-term rates or loan rates go up, you'll see that they go like two boats in the ocean. Now I could show all the figures and data, but this is what the client needs to hear. Now, they are always interested on how indexing works, and this is a very simple way of explaining it. I don't know if the carrier would like it because they get a little deeper than this, but this is what the client should know. This is what's called a general account product, and an IUL is a general account product. What happens is all the money goes into the general account of the insurance carriers, and they invest it. So if I had a cash value of $9,000 and I paid $1,000 in premium, that would go into the general account fund. Now, the general account fund takes that money and they say, based on how well they're earning, what they do, they take their spread of what they need to make off of that, and then the rest, they invest primarily in bonds. And so we're in a really low bond rate environment. So of the 10,000, because it's an index product, it has to get back to 10,000 at the end of the year. So what they do, they invest what they need into instruments that guarantee 10,000 at the end of the year. So in this day and age, they may take 9,500 of the 10 grand, invest it in bonds that will get back to even at the end of the year. And they guarantee that. That's our guarantee of principal. The remaining 500 is what's used to purchase an option on the S&P 500. Today we may have a 12% cap. If you've been in the market a while, you saw unlimited caps. You saw 18% caps. You saw different indices that had monthly sums, all sorts of stuff. But let's suppose we have a 12% cap. So what that says is you'll get 100% of what the S&P does with a cap of 12. So if the S&P loses money, then the cash value over here grows back to 10,000, so they guaranteed their principal. We lost the 500 over here because we didn't cash in on the option. We gave it up. So that's if the market loses. If it earns 12% or the cap, the cash value now earns 12% and it's now 11.2. That's a pretty good net rate of return instead of taking a current crediting rate. And that's why people do this. Now, what if loan rates go up? Let's say they go up to 10%. Well, we know if loan rates go up, we know that bond rates are going up. So they may be higher than 10%. So what happens is the carrier's general account fund is earning more money, over 10%. So what they have is maybe lesser amount that they could invest to get back to the 10 grand. So they may invest 8,500 to get back to 10,000 because they're making more money. Over here, that leaves $1,500 to buy the option, and that may purchase a 20% cap. So in that situation, let's suppose my loan was 10% and I received a 20% return. I'm now 10 points ahead of where I need to be, actually about 8 points ahead of where I need to be, and everything's copacetic. And that's kind of how things work as far as within the contracts. Now, a lot of people will say, well, shoot, What if interest rates go down and all I have is I'm just paying not only the loan rates, but I'm paying mortality and expense. Well, because we're overfunding these contracts, you're seeing we're putting in far more than what we need to get a lot more cash value. Now, red is the cost of insurance, and gold is the cost of bank interest. You can see it's relatively low based on the growth of how much money we're putting in. And I'll kind of show you by putting in max funding, we can survive, let's say, 10 years of zero net returns, even though we're paying loan interest rates. All right, so that brings us to the second question that a client will have. What if crediting rates remain low for several years? Well, a couple things. We stress tested it through the worst crediting rate environment in history, and that was the Great Depression. We had, from 1929 on, we had zero growth rate for 7 out of the first 10 years. In fact, we actually tested it showing zero crediting for 10 years, and it successfully survived. And it's not that the insurance goes away. It's more depending on what you earn is like a 401k. In other words, if you earn 7, you would get X. If you earn 9, you'd get more. And if you earn 5, you would get less. And so treat this like a true investment, because nobody says to their 401k provider, well, show me a crediting rate of less than -6. Well, you know what would happen. It would go under. At least we have a 0% floor on our contract. Now, this kind of shows you the comparison. If I'm putting in 34.5 a year and our lender's putting in 37, if we surrendered and paid off the loan, in other words, we take 63.9, pay off the loan with interest, and we have 25.2 left. So in other words, our net surrender charge was about $11,000 in the first year. And you would know that if I bought $1.5 million of GUL, that premium may be, let's say, $16,000 to $18,000 a year. What do you think the surrender value is of that in the first year? Yeah, 0. So in other words, if I surrendered a GUL in year 1, I would have lost $16,000. Here, I would have lost 11. But you can see here that at least you're ahead of the game every year. So if I borrowed 37 the next year, it's going to go up by about $30,000. And so I'm increasing my cash surrender value, and it will outperform the loan rate plus mortality and expense all the way out. Now, I'm a little more concerned after the 10th year, even though I've got a net surrender of $209,000. At that point, when we stop paying premiums, I'm a little more concerned about the spread between the loan and the crediting rate. All right, so the third question is, what if I can't afford the 5 annual payments, or I can't make a future payment? Same thing. Let's take a look in the third year. I've got, if I surrendered, I would take 204, pay off the loan with interest, and I have almost $86,000 in my account. Now, at that point in time, the lender will call the loan if I don't make this next premium. So I've got $85,900 of cash in my account. The loan's paid off. What do I have now? Well, I have a traditional IUL that allows me a lot of different flexibility and a lot of different options. So I could sit on this and let it grow for a while until I get back on my feet, or I can take a withdrawal of, let's say, $20,000 if I needed it, or I can find out what the mortality and expense is and pay that every year. So let's suppose that was $2,500. If I put in $2,500 instead of $34,500, this would remain intact and probably grow. So every flexible part of this IUL is available to me, I can utilize. And so it's just no different than what everybody else has purchased out there. It's just not financed anymore. All right, now let's get into compensation. What you should know about comp. First of all, there's a split on the Kai-Zen program of 70-30, and you get the 70. For that, here's what we do. We create all the spreadsheets. We facilitate all the legal work and the trust work. We complete the annual review calculations every year. We prepare the first year lending and all of the lending renewals. The agent basically has to make the sale and obtains an underwriting offer. That's about all they have to do. Now the split on the app is on the app. So in other words, you aren't necessarily contracted with NIW. You have your upline for various companies. Right now our main companies are National Life Group, Allianz Life, and Minnesota Life. And they have different products, and you'll find that out. Now all Kai-Zen contracts utilize what's called a spread comp option. And that means that your commission is spread out over time. And that's the only way we could allow the banks to have enough collateral for them to provide these loans without having any documentation. And so we couldn't do this without spread comp. Now, if you're not used to spread comp or you don't like spread comp, this product is not for you. However, those that have done spread comp fall in love with spread comp. So how does that work? Well, there's two ways to earn commission. One is a percent of what's called a target premium, and there's a target premium based on age and the amount of coverage. Also, there's a percent of what's called excess premium. So anything over target, let's suppose I have a $100,000 premium and my target's $25,000. That means there's an excess premium of $75,000, of which you'll get paid a compensation on, or a percent of comp. Now, commissions on target is paid one of two ways. One, all in year one, and that's all up front, which a lot of you are familiar with. And two is over a period of years, which is our spread comp. With National Life Group, it's 6 years. And so you would get paid over 6 years. Why do we use a spread comp? Like I said before, more surrender value in the early years, which is actually better for the client. In other words, for a client, cash is king. Two, more money for the banks to use as collateral. And so it's necessary that the banks are comfortable so that they allow us to do this without the applications. Now, is spread comp a bad thing? I don't think so. And I'll take an example of a $25,000 target. Now remember, whether you use spread comp or upfront, the target is the same. So it's how you get paid on the target that's the issue. So if I had a $25,000 target and I was at a contract level with the carrier of 80%, and that's just could be anything, then if I'm paid up front, I'll get $20,000 or 80% of the $25,000, and that's a nice payday. However, if I'm paid using a spread comp, what they do is there's a correlation between your 80% upfront comp and they give you a 1.7% comp. These are the same depending on how you're going to get paid. So the 25 times 0.17 is $42.50. However, you get paid that over 6 years. So every year when you wake up on January 1, you know you're going to get paid that again. So you get paid $25.5 over 6 years. That's a difference of 27.5% more income between the 20 and the 25. Of course, you get paid over the 6 years. But you would have to put that at interest, pretty good interest, to make up the difference. Now, I'm going to show you the difference between financing versus no financing. In other words, no Kai-Zen versus Kai-Zen. And let's compare the same index product, but one with financing. Now, you'll see I'm a male, 45, 7% crediting. Here's your traditional IUL, and here's Kai-Zen. Well, there's some psychology going on here with the agent force of who would not use Kai-Zen and who would. So if the premium was $34.5 for 5 years for both, and the total client premium would be the same for both, here's the financing, 0. Here is the total loan that you would get on the Kai-Zen contract. So that's the big difference in the financing side. Now the death benefit would be the same. I'm going to use option B on both contracts. So the cash value at 65 for the non-financed, after we've paid off the loan, is $286,600. That's a 2.98% net rate of return. Now it's kind of like what I just showed you as far as 2.08. This was a little different. Now with Kai-Zen, we have, after the loan is paid off, $557,000 in cash for a 7% net rate of return. Not bad. So you can see, if I'm going apples to apples, I'm going to crush the competition. Now what's been accomplished? Premium and face are the same. $270,000 more cash in our contract, and a much better net rate of return, 7% versus 2.98. However, how would an agent have to compete if they didn't want to use Kai-Zen? Well, there's a couple ways. Here's the Kai-Zen on the left now, the IUL policy on the right. I'm sorry, I switched you on this. I'm going to take the same premium, and I'm not going to use a balance sheet benefit rider because, you know, believe it or not, there's a lot of agents out there that want the money up front, so they won't use the balance sheet benefit rider. So what does that do for the client? Well, here, you know, you have the same premiums, same death benefit. Oh, not the same death benefit. Because I'm not financing over here, I don't have the same MEC guidelines. So I can reduce the face down to $780,000. That will improve the cash value, won't it? Because I want to be as competitive as I can for the client. So I'll also switch to option A. And by switching to option A, I'll have more cash, and that's my objective. So what happens? Well, let's look at the death benefit in year 10. It's $780 because I went option A. Over here, it's $1.79 because I used option B. Now, if I was in competition with this guy over here, I would say to the spouse, if Bill dies in year 10, my contract will give you $1.7 million tax-free. You're $1 million behind over here. That's not good, because this is actually valuable to the spouse. That's a $929,000 difference just in 10 years. But you weren't buying it for death benefit, where you were buying it for growth and income. So let's look at the growth, the net cash value in year 1, $25,700, because I have the early balance sheet benefit rider, $10,300 with no balance sheet benefit rider. So I'm behind about $15,000 in year 1. So that doesn't look good over here. However, the cash value had to exceed it because we've done all this to exceed the cash value. So I have $557 in Kai-Zen, I have $370. I'm still behind $180,000. So there's not really anything good for the client to see on this side. Now the net rate of return, 7 over here. Now I was able to increase that to 4.65 by doing all of this. Still not very good. Now Kai-Zen definitely has severely beaten the competition. However, how's the compensation after we split with NIW? I'm going to assume the same 80% contract. Over here, the target premium based on 1.5 million was 17,000. Over here, because we reduced the face to get more cash, yeah, I missed that. Here's the comp at 70% of this, because you're getting 70% with the split. So you would get 12,138 at 80% and 70% split. And you're upset about that. So you're $5,000 behind. Over here is 780 reduces my target to 13.2. But I get the full 80% of that, which is 10.5. So I'm behind Kai-Zen, even with the splits, by about $1,500. But that's not where the action is. The action is the excess commission, because over here, because we're borrowing so much, that's just premium that goes to the insurance company that you'll get paid on. So based on that contract level, you would have gotten another $7,700 in excess premium because you're getting paid on the loan as well. Over here, you've stopped paying this amount, so you've got $159,256 for 5 years. You would have gotten paid $3,180. So there's a big difference in the excess. So if we totaled it up, you would have made $19,800 by using Kai-Zen. Here, you would have gotten $13,700 without using Kai-Zen. If you sold it, you would hope that you weren't in competition with Kai-Zen. That's a 44% increase in compensation, even with the split with NIW. So you can see over a period of time, you're really going to excel in this thing. Now, I always show compensation based on not just onesies and twosies, but you've got to sell groups and you've got to sell a substantial amount. So let's suppose I write only 10 cases in a year. That's less than one a month. Or I sell one group case of 10 key men policies, and I do it one time. Here's my comp for the first 6 years, then for the next 4 years, and here's my total comp. I would have made just shy of $200,000 by writing only 10 cases. Now, of course, we don't stop there. Let's say we do this for 5 years and then stop. So the first year, I'm going to get this, second year this, third year this, and you're seeing I'm getting this for first year, second year, third year. In the sixth year, you've made $134,000 that year, and then all of a sudden it kind of you've retired and you still get this. So over a period of 14 years, you've made just shy of $1 million by writing less than one a month for 5 years. So you can see here now, if I compared that to if you did it on your own, you're looking at about $600,000. So you can see the advantage of writing Kai-Zen. All right, now, the moral of the story, if you're selling life insurance for income, Kai-Zen will always outperform a traditional IUL, and you'll actually make more money doing it. So I always get these questions of how that works. And now I'm going to open it up for questions. And you know this is a fairly short webinar this week because compensation is important, but you had to understand that. We have about, I would say, 5 or 6 different Friday webinars that we do, and this is just the compensation one. So try to get on at the other ones if you can, because we'll get into how your process works, you know, soup to nuts of how Kai-Zen works. We also have one called Tri-Zen, and Tri-Zen is actually Kai-Zen in which you can pay the premium on a pre-tax basis instead of after-tax. So that's kind of a fun one. So with that said, I'm going to open it up for questions if you have any, and you have a little hand that you can put up. Oh, Bill just put a hand up, and then I'll just, hey Bill, are you on?
Yes, sir, I am.
Hey, what's going on?
Good, good. I appreciate the presentation. Thank you.
Uh-huh.
If we had a well-to-do client, let's say net 20, 30 million, would they be able to do a lump sum payment that includes all 5 years so they don't have to keep putting in annually? Can they do a lump sum for 5 and be done?
Great question, and I'll kind of elaborate on that. Yes, they have a trust that they own, and so we could put all 5 premiums into the trust, and the trust will pay the annual premium for 5 years. And so
okay, great.
Yeah, the advantage is that we don't have to worry about a MEC premium. And that's always something that we're very concerned about, that it doesn't MEC out. The other thing is that you can do any percent you want. You may want to put 2 years advance in there or 3 years. It's up to you. And then we would create a sub-account within your trust if it's interest-bearing.
Oh, very good. All right. Yeah. Thank you.
All right. My pleasure. Thanks for being on. Okay. Let's see what we've got here. Christopher, I'm not so sure that, let me try to see if you're on. It shows that you're muted. You haven't sent in your audio pin. That's kind of a prerequisite in order to hear it. I'm going to keep you there and see if you can get back on with the pin. There's Eddie. Oh, might not have. Eddie, can you hear me?
Yes.
Hey, how you doing?
I'm doing good, thanks. That was a great 2-day seminar. I was down there earlier this week. Thank you.
Yeah, I'm glad you were there.
My question on this compensation webinar today, you point out all the first-year commissions, and I'm I've been in the business 25 years, so there's renewal commissions somewhere in there too, isn't there?
Yeah, that's what's called excess. That's what I would call excess premium. So in other words,
You didn't even illustrate that.
a renewal is the same thing. In other words, if they put in a renewal premium, you would get paid target plus excess for 6 years. Now in years 7 through 10, you'll get excess premium on anything that's put in there. So you're consequently you're getting commission on the borrowed money.
Is that renewals? I mean, I refer to them as renewals.
Yeah,
You call it excess.
Yeah, that would be renewals. In other words, if I put in 100 grand and my target was 25,000, the excess premium on the 75,000 over the target, that would be what is commissionable at that level. Does that make sense? In other words, the 100,000 is considered a renewal premium, but you'll get paid 2 ways on the renewal.
Right. And the money that's accumulated in the policy, that still, we get a service fee. I mean, I can't remember exactly how our EIUL works, but
that is
residuals.
That is what's considered trail commission.
Correct.
And I'm not so sure we've got trail on any of our contracts on these with the Flex Life and the Allianz, and you might have to check each one to see if there's trail commission on those. It's in your contract.
Okay, thank you.
Thanks for coming over.
You bet.
Yep. Okay, let's see. Eamon, you're going to have to get your pin in so that I can hear you. Right now there we go. Let me try you. Did you get on?
Hello,
Eamon?
How are you doing?
Hey, great.
Hi, Dave, how are you?
I'm great.
Dave, thank you for the awesome presentation. This is very, very important. Two questions. One, when the client wants to pay the earlier question that they want to put 5 years of money up front in a sub-trust, do they earn interest on that sub-trust?
Yeah, we can. It's up to them what investment they want to use in their own trust. So they could use a money market account, a bond fund, anything that they want, they could put in there.
Okay, and where do we see that? What options they have, or?
Well, that's kind of something personal. In other words, they'd have to create that personally rather than come to us. Now, they could go to their life insurance contract and say, do I have an annuity that I can use in here that will pay over 5 years?
Okay, got it.
Okay.
And second question, this presentation that you did, is it available on the website?
It's not on the website, but I'm recording it. So it should be in a YouTube video. You'd have to log in and get it, but I'll have this available in a couple days.
Okay, wonderful. Thank you so much.
All right. Thanks, Emma. All right. Let's see. Let's go down the road here and see who I've got. Hey, John. John. Mr. McIntyre.
Yeah, Dave, can you hear me?
Yeah, I can now.
On your next Kai-Zen presentation, can you show like a 50 employee doctor group that's going to pay like $100 million and kind of show the mechanics of, if they're going to amend their contract, whatever, how much, and then kind of go through how, if I'm trying to explain it to a CFO, basically the pre-tax and all. Yeah, that would be awesome.
I have that already.
You do?
Yeah. So email me.
Okay, will do.
You got my email? Well, here, it's right in front of you.
Yep, it sure is.
All right, John.
All right, have a good weekend.
You too. Thanks, John. All right. Ken, are you there? Mr.
Yes.
Hey, what's going on?
I have a question for is it possible to do an existing policy that's only in the first year? They put $100,000 into Alliance IUL, and there's 4 more years remaining.
Yeah.
Is there any way you can work that into a program?
I'd love to say yes, because I hate to say no, but that's a no one.
Okay.
Now,
And,
it's kind of a catch-22. In other words, if you've got surrender charges, that's the concern. Now, what you might want to do is say, well, wait a minute, if I've got 20,000 of cash surrender in that contract, maybe I'll create a mech and reduce the face as much as I can and let it just pay up for a while.
okay, well, I was just wondering because of the existing contract, you already got the contract in place.
Yeah.
Instead of paying a percentage, taking that contract and applying it in there because there's been $100,000 already applied on that.
Right.
But it doesn't get the chance for the overpayment to build up the cash. I do see that. So I kind of answered my own question before I asked you.
That's kind of what we always do, I think. It's just good to talk it out.
And well, I love the concept. I have a lot of opportunity here with some that I've been looking at. National Life is a product that we really push here, and so I've got a couple in the works here that I'm bringing in here. So I do appreciate your time.
Oh, sweet. Thank you so much, Ken. Appreciate you being on.
All right, bye-bye.
All right, see ya. Okay. And then some of you have put in question marks, and I'll address those at the end because you'll just probably say, here's what my question is. Answer it. And let's see. Iman, did you have another question?
Yes, I do, Dave.
Okay.
One of the questions you said that a national life group can go up to 4 million without reinsurer.
That's correct.
Okay, so that's one question. And another question comes to my mind as it gets more creative and more interesting. Let's say I open a Kai-Zen, for example, myself. And then, I'm putting my money, the bank is putting their money. After 1 year, I want to get a second one. Can I get a second one, or do I have to wait 5 years?
As long as you can get it approved, you can do a second one.
Okay, as long as it's insurable.
How about this idea? Is that a client might say, well, wait a minute, at the end of the 5th year, can I do one in the 6th year? And the answer is yes, but there's more of a chance that in 5 years you may be uninsurable. So what you would say to the client, if you want to protect against that, let's write let's say a 10-year term policy, and we'll fund that for 5 years, and then we'll have a guarantee that we can convert that in the 6th year. It's just a way to ensure, take care of insurability issues.
Awesome. Can I ask you more questions?
Sure.
All right. With the Tri-Zen and doctor groups, I think they're tied together. So we can use the Tri-Zen to do their, let's say if their employer is funding for them and doctors.
If the corporation that's paying the doctor is a C Corp or a not-for-profit, yes, for sure.
Okay, so if it's a C Corp, there'll be, let's say, like a bonus, executive bonus would be the category, or anything key employee. What would be the?
Well, they can do this on a key employee, or they can do it on an outside vendor that they pay. So let's suppose I have a radiology group that has their own company, and the hospital then turns around and says, well, we won't bonus you, we'll loan you the premium. And the loan is not taxable to them.
Got it. Okay, yeah. I guess I got to sharpen up my skills more on Tri-Zen because I have quite doctors that I work with.
Whoa,
I can get to their group.
Those are great cases.
I'm going to need your help. And do you guys, let's say if there's a big doctor group, can you guys fly out and help with the presentation, or?
Well, what I would normally do is your job would be to do a little fact finding for me, and then I would start with a webinar. And then if they decide to take a next step, I'd probably go out.
Okay. And is there extra comp, or is it 30% satisfied?
Well, actually, in the Tri-Zen model, you get me regardless because the split is 50-50. With the Tri-Zen model, we're going to increase your target by as much as double because Uncle Sam's going to help increase the target premium for us. In other words, if you had a Kai-Zen case that you were going to put in $50,000 a year, how much would you have to make to net 50? Well, in California and New York, probably $100,000. So you would
Yep.
make 100, pay 50 in taxes, and you have 50 left to buy Kai-Zen. Well, with Tri-Zen, we can take that full 100, loan it to you, and so you get the full 100 in your account. What does that do to target premium? It doubles the death benefit because it pushes that up based on MEC limits. So that increases your comp. So now that's not why we went 50-50 on this. The reason why we went 50-50 is that we pay accountants and CPAs and attorneys to draft all these agreements and to make sure that it's all, vetted properly. And there's just a lot more administration.
Okay.
Okay.
So they can use their income instead of paying taxes and funding Kai-Zen after tax. They can just use that money and do
Put it
it pre-tax money.
Exactly.
Okay. And they can use it. The corporation doesn't have to match anything.
Nope. All they have to do is loan them the premium.
Okay. Instead of income.
Correct. And then, the nice thing about the employer loaning the money to the employee is that is a loan and becomes an asset for the employer because they'll get that back when the client dies.
Okay. So then there's no more bank financing. It's just the employer financing.
No. It's just like Kai-Zen. There'll be the same bank financing, but imagine now you're getting instead of 50,000 on the 50,000, you're going to get 100,000 on the 100,000. So you're going to get twice the bank financing.
Got it. And then the Kai-Zen doubles as well. Okay.
The Tri-Zen doubles. Wow. Yeah, it's huge.
This stuff. Yep.
Yeah.
Thank you very much, Dave.
Get with me.
Thank you. Thank you so much.
All right, man. See ya. Great questions. Let's see who. I'm going to go to the. Bill, are you back, or did I not take off your hand?
No, I'm still there. Real quick, this is an easy one for you. If my client has an existing IUL and has a decent cash value, let's say 200,000, can they transfer that cash value into the cash value of the Kai-Zen, or are they just kind of limited to making premium payments?
Well, here's what I do is if you were doing a quote unquote 1035.
Correct.
The problem with the 1035 is that money comes in 2 to 3 months after we've funded the first year. And it's not financed because the finance is on the annual premium. So you wouldn't get the bang for the buck. Now, what I would recommend is if they don't have a big gain in the policy, I would take I would surrender it. What I would do, I would take a withdrawal for the first annual premium of the Kai-Zen. And then once the new policy is in force, I could take a withdrawal of the remaining balance and put it in my trust to pay future premiums. Then I get financed on top of those 1035 monies.
Gotcha. Okay, I'm tracking.
Yeah, good.
All right, thanks.
All right, buddy. See ya. Let's see. Well, we still got some. Ooh, got a new guy here. Hey, Dan.
Yeah, hi, how are you?
I am just super. Thanks.
Good. Just a quick question, since you did kind of cross over into Tri-Zen land. I want to anticipate an employer concern, and that is, obviously with a loan, well, let me backtrack a step. What typically, in addition to the principal that's laid out for the loan that they're going to get back at the death benefit, what return on that are they going to get? Is that an AFR or a 75-20 rate or something like that?
It is an AFR, and we use the long-term AFR rate that we can lock in for life expectancy less 1 year. So if a guy has a 35-year-old life expectancy, we can lock it in for 34 years, basically. Now, the June long-term AFR rate is going to be, I think, 2.68%. So that, and then we're allowed to accrue that interest. So, and there's plenty of death benefit to not only take care of that, to provide a bigger benefit to the heirs as well.
Mm-hmm.
So, yeah,
okay,
it's really nice when you can accrue interest because basically it's out of the way.
When you say accrue interest, you mean on the on the balance sheet for the employer, accruing the interest without having to pay the tax on the accretion of interest?
Well, the employer, yeah. In other words, if it's a C corp, they would probably pay the tax every year. So they would book, let's say 40,000 of interest is shown as that year. They would probably book that as income that year, and when it's paid at death, it all comes in without tax.
Okay, so you do have that phantom taxable income each year then with this program?
You do, but it's still an asset on the books.
No, I understand. Okay, so thank you. I appreciate that clarification. So coming back to my central thought was, the employer's going to obviously say, well, we could probably do a lot better by reinvesting our surplus cash and making a loan at these locking in at 30 years at 2.92% and having to pay tax on it every year. It's just an objection I think I would have to address.
Well, you could think of it as an investment like that, but the ultimate underlying issue is retention of a key employee. So in other words, if you could retain an employee rather than pay them comp or deferred comp, it becomes an asset to them. They don't care if they get 3%, that just increases the asset base on their, even though there's phantom income. It's a small price to pay for picking that asset up. Now, if they say,
I can understand it. Everything comes back to employee retention, and every employee retention involves a cost of some sort. So that's the cost is
if they don't
the foregone.
If they don't care about retention, it's a tough sale.
Maybe shouldn't even be trying it in the first place if that was the case. Sure.
Now, on the other hand, if let's suppose a hospital says, well, we can't afford to do this and we don't like the 3% phantom income, even though they don't pay tax. A not-for-profit won't even worry about phantom income because they're not paying tax on it. A C Corp would be. But so in that marketplace, even if the corporate CEO says, we don't want to put any more into our employees, but we'll offer it to our employees if they want to put their own money in. Now that's
smart.
That's a big advantage to the corporation, because now if a guy says, yeah, I want to put in $50,000 a year pre-tax, then he reduces his comp by 50. They take that 50 that he reduces it by and they loan it to him. Now they pick up 50,000 of asset that they would have never have had. It would have been an expense.
Okay, got it. And then that for the nonprofit, since you mentioned the nonprofit, that would not be a UBIT taxable item, would it? For sure.
It would not, because it's used as a way of retaining a key employee. That's the business purpose.
Yeah, no, absolutely, I understand. Okay, great. Well, thank you for that additional commentary. I was thinking a little out of the box there. I'm sorry, but I haven't had your. Okay. Thanks a lot.
It's
Have
all
a good
fun,
weekend.
isn't it?
You got it.
All right, thanks, Dan. All right. Wow, great questions. Well, you guys always have good questions. All right, I've got a few. Let me see. I'm just checking the last ones, see if I haven't missed anybody, because I hate to miss somebody that has a hand. Oh, there's Dave. Hey, Dave.
Can you hear me?
Yeah, I can. How's it going?
Good. So you mentioned something in your seminar the other day in Texas about how the corporation could make 9% on the loan, and I didn't quite understand that.
And sorry for everyone else to kind of jump in. Here, what I was saying, and this is on the Kai-Zen model for all of you that are on the phone. If a corporation decides to tell every employee, or 10 employees or 100 employees, we're going to put in $15,000 a year for you on behalf of this program for 5 years. All right, that's a corporate contribution. Now, they'll make that becomes an asset to them, and they'll make, let's say, roughly 3% or whatever the AFR rate would be. Correct?
Right.
So they're making 15% on their own money that the corporation put in. Now, at the same time, they're saying to the employee, you can put in any amount that you want in addition to that of your own money. So let's suppose a guy says, I want to put in $30,000 a year. Now, what happens is he reduces his comp by $30,000. They take that $30,000 and they loan it to him, right?
Correct.
Now that $30,000 is also a loan, but it didn't come from the corporation. It came from the employee that would have been gone and expensed. So in other words, they're saying now, not only am I getting 3% on my $15,000, I'm getting 3% on the additional $30,000. That's basically 9% on my own 15 that I put in.
Okay. All right. Yeah, that's wonderful.
Yeah, it's outrageous.
So if you put in 45, they'd get 12.
Exactly. Great way to put it. I hadn't heard anybody do that, so I was thinking, yeah, that'd be pretty interesting to lay it out that way.
Thanks for the clarification.
Yeah, I'm glad you got it because it makes me think how many people didn't understand that. I'll have to, maybe make it a little simpler. But boy, thanks for coming this week, and once again, I'm glad you're on today.
Yeah, it's great to be here.
Yeah.
I'm excited about the product.
Awesome. All right, Dave. Thank you so much.
All right. Thanks a lot.
See ya. All right. Still here. I know we got a little off base for the newbies. Now, let's see. I'm going to go to the questions and see what we've got here. Now, quite frankly, there was one time when I got to the questions and it said, we can't hear you. So I blew the whole presentation. All right, here's a question from Robert. Are these sessions in the back office? I'm recording this one. We have a lot of recorded ones, and we have some PowerPoints that are on the website. So check with the home office. You can call and ask for Stacy, who is my assistant, Stacy Rourke. And let's see, I didn't put I hope you have the national, well, you've gotten emails from NIW, so get that number. If the client can't make the premium, is it possible for them to take a loan out of the surrender value without the bank note being called? No, can't do it. If you take any money out or even go access the living benefits, you're going to have to pay off the note just to get access. Now, if we say that the money's liquid, it's liquid after the loan's paid off. Now, I can pay the loan off in the first year if I need to. Of course, we don't want to, but I could. Now, that's just a personal preference. In other words, let's say in the second year, I suffer a heart attack and I need $1 million. Well, I would definitely pay off the loan to get that $1 million, if that makes sense to you. Here's, there were two, here's a question. Well, all those questions were, Kevin has left. Here's the question. If I'm able to do a second premium finance when I pay off the loan at the year 15, there were two different annual incomes in your charts. One said, oh, here's the question. When I had a 50-year-old, it was less income or more income than the 45-year-old. And the individual is very astute and picked that up. Why did that occur? Is because in the 50-year-old, we showed a 15-year income. The 45-year-old, we showed a 20-year income. And that's the difference there. So that's actually a great question. All right, I'm looking here. We're getting close to the weekend. So that's it. I want to thank everyone for being on. Hope you have a great weekend and happy selling. And just call us if you have any questions or write us. You have my email address. And happy writing. We'll see you. Thanks.